Look, have you ever stared down the barrel of a massive, multi-million-dollar corporate transaction and thought, man, what if the tax authority sees this completely differently than my legal team does? Honestly, it's the ultimate nightmare for any strategist or CFO. Tax ambiguity isn't just some minor administrative hurdle you can jump over. It's a total deal killer. It is literally the ultimate risk. But what if you could actually guarantee your tax bill before the ink even dries on the contract? Well, welcome to our explainer, because today we are going to dive right into a tool that practically hands you that exact guarantee. Today, we're exploring the Inland Revenue Authority of Singapore's advanced ruling system. You really want to think of this as your absolute ultimate shield against tax uncertainty. Because when the stakes are high, you don't want assumptions, right? You want a rock-solid, binding promise from the taxman. And that is exactly what this system is built to do. I'm super excited to walk you through how to navigate this incredibly powerful yet rigorously guarded mechanism. Here is our roadmap for today. First, what is an advance ruling? Second, when rulings get rejected. Third, the application process. And finally, number 4, fees and timelines. Let's get to it. Section 1. What is an advance ruling? The ultimate shield. Okay, so first things first, what actually is this thing? An advance ruling is a formal written interpretation by the Comptroller of Income Tax on exactly how the Income Tax Act 1947 applies to a specific proposed arrangement. Now, the absolute keyword to zero in on here is specific. This isn't just you calling up IRS for some friendly advice or bouncing a hypothetical scenario off them. No, this is about a very real, very proposed transaction. And when IRS issues this ruling, it becomes a binding contract of certainty. It legally binds the comptroller to apply the tax laws exactly in the way they set out in that ruling, provided, of course, that you actually execute the transaction exactly as you described it to them. Like we said, it's literally a shield of certainty. Section 2. When rulings get rejected, the boundaries of the shield. Because as amazing as this shield is, it definitely has its limits. You see, IRS isn't here to be your personal consulting firm, and they definitely aren't here to do your homework for you. There is a very hard dividing line between an application that gets approved and one that gets immediately tossed out. On one side, you have a bona fide commercial reason. This means you've got a totally legitimate business transaction that genuinely requires a legal interpretation of the tax code. On the exact opposite side, we have what IRS explicitly calls a vexatious application. If they look at your proposed deal and conclude it's basically just a scheme where the main goal is to avoid or reduce your tax bill, they're going to decline to rule. They consider it frivolous, they consider it vexatious. And actually, this story brilliantly illustrates exactly what IRS means by a vexatious tax avoidance scheme. This is a real example straight from the tax authority. So, picture this. Company A is a Singapore company earning a bunch of royalty income from its trademarks. They decide to set up a wholly owned subsidiary in a low-tax jurisdiction, and they sell all their trademarks to it. Company A tells IRS, hey, this is an outright sale, so the subsidiary can exclusively focus on managing these trademarks. But wait for it, here's the catch. This new subsidiary has absolutely 0 employees. None. It just uses a local agent to handle the basic incorporation paperwork. Oh, and the transfer price for the trademarks? It's only paid as and when cash flows happen to be available. Company A then turns around and asks IRS for an advance ruling to confirm that the gains from this sale won't be taxed and future dividends won't be taxed either. IRS's response? An incredibly hard no. In their eyes, this transaction is entirely artificial. It's a classic shell company. There is 0 bona fide commercial reason here other than just dodging taxes, so application denied. But hey, outright tax avoidance isn't the only way to get your shield shattered. Here are a few other surefire ways to get your application thrown right back at you. First up, asking them to interpret foreign laws or double taxation agreements. Simply put, that is not their job. Second, if IRS has already started an audit or an investigation into your company about this exact arrangement, you can't just use an advanced ruling to try and preempt them. Nice try, but no. But honestly, the most common reason for rejection is asking for a ruling on something the law already makes perfectly clear. For example, Section 1311ZA plainly states that dividends paid by a Singapore resident company are tax-exempt, or Section 13W, which gives really clear conditions for tax exemption on share disposals. If your deal clearly meets those established conditions, there's absolutely no interpretation required. The law is the law. You really don't want to waste their time asking for a ruling on something that is already written in black and white. Section 3. The application process, mechanics of certainty. This is where we see exactly what it takes to secure this guarantee. Look, the application process requires a massive amount of heavy lifting from you. You can't just fire off a quick email asking a question. You have to submit an incredibly comprehensive description of the arrangement, the background of absolutely everyone involved, and the pure underlying business reasons for the deal. But take a close look at those last 3 bullet points. You have to bring the legal propositions yourself, the specific sections of the act, the relevant case law, and the legal reasoning that supports your interpretation. And then, you have to do something really fascinating. You literally have to provide possible arguments contrary to your own case, complete with their authoritative support. And finally, you have to submit a draft ruling. You're practically doing the judge's work for them. You have to lay out the entire playing field, the arguments for and against your own case, before they will even consider looking at it. Once you hand over that massive dossier, the review pipeline actually flows pretty logically. Step 1, obviously, is the submission. Step 2 is all about answering query letters. Basically, IRS will usually shoot you a first query letter within about 6 weeks if they need more info. And sometimes they'll even send a second one. You need to reply to these promptly. Once they're finally satisfied they have the whole picture, we move to step 3. They will issue a formal letter of offer to rule, which includes an estimate of the fees. You have to officially accept this offer and pay those estimated fees. Only then, at step 4, will they actually process the file and issue that final binding advance ruling. All right. Section 4, Fees and Timelines. What is the actual toll required to cross this bridge to certainty? Let's talk numbers, because the financial reality here is crucial. First off, there is an application fee of 660 Singapore dollars. Now pay close attention, this is strictly non-refundable. Even if IRS takes one single look at your application and immediately declines to rule, they keep the money. That $660 just covers their time to figure out if they can even give you a ruling. Next, we have the time-based fee. The first 4 hours of their review are baked into that application fee, but after that, you're on the clock at $165 an hour. Like we talked about with the process, IRS will estimate these hours in their offer letter, and you pay that upfront. If they finish early, you get a refund. If they go over, they'll send you a bill for the difference. There are also potential express fees, which we'll get into in just a second, and reimbursement fees, just in case IRS needs to hire external professional advice, though they will ask for your permission before doing that. So what about the timeline? 8. Once IRS has your acceptance letter, you're tracking absolutely all the complete information they asked for. It generally takes 8 weeks to issue the ruling. 8 weeks is the baseline. For a corporate strategist, this is a massive reality check. You cannot wait until the week before your mega deal closes to suddenly decide, hey, we should get some tax certainty on this. No way. You have to build this 2-month window into your transaction timeline right from day 1. Now, there is one very specific fast track: 4 weeks. If your ruling request is solely about the adequacy of economic substance regarding gains or losses from the sale of foreign assets, specifically under Section 10L of the Income Tax Act, IRS will generally turn that ruling around in 4 weeks instead of 8. But what if you're just in a huge rush and need an express ruling on a standard application? Well, an express ruling cuts the time down to 6 weeks. But listen very carefully here. IRS explicitly states that because you are fully expected to plan ahead, they basically never agree to express rulings except in truly exceptional circumstances. And this is my favorite part. They specifically call out that things like impending board meetings, upcoming listing dates, or needing certainty before the completion of a deal absolutely do not count as exceptional circumstances. Basically, your poor planning does not constitute their emergency. And hey, if you somehow do manage to get an express ruling approved, you'd either be prepared to pay an additional fee of up to 100% of your application and time-based fees. Which really brings us to our final thought for you today. Is your next major corporate transaction built on a guaranteed interpretation of the law? Or is it just sitting on a really, really costly assumption? The IRS advanced ruling system requires some serious heavy lifting. It takes full transparency, a ton of legal groundwork, and quite a bit of patience. But in the high-stakes world of corporate finance, removing ambiguity isn't just checking a box for compliance, it is a massive competitive advantage. It secures your margins, it completely protects your stakeholders, and it allows you to execute with absolute total confidence. So as you look at your deal pipeline for the year ahead, you've got to ask yourself, is it time to stop assuming and start securing your certainty? Thanks so much for joining us for this explainer.